Welcome to the deep dive. Today we're looking at a pretty massive stack of on-chain data, regulatory filings, and market reports from late May 2026. Our mission here is to figure out why a really loud retail panic in the crypto markets is basically masking a silent accumulation by institutional whales.
Yeah, it really is a split screen reality right now. I mean, the divergence is just wild.
Completely. Because, we've got Bitcoin slipping into the 73K range. Ethereum is dropping under 2 grand. So if you just read the headlines, it sounds like a total retreat.
Right, but then you actually dig into these filings, you see the CFTC, the commodities regulator, greenlighting 247 derivatives.
Yeah.
Texas is building a sovereign Bitcoin reserve, and the New York Stock Exchange is suddenly eyeing DeFi. It's exactly that divergence that makes this data stack so fascinating.
Exactly. And we had those hot inflation readings recently, which, triggered a classic macro correction. Retail traders saw money leaving the ETFs and they just immediately sold off.
Right, they panicked. But the on-chain data shows large institutional holders stepping right in. They aggressively bought up that $73,000 dip to absorb the sell pressure.
Oh, wow. So they just ate it all up. And we can actually see how confident they are by looking at the options market, right? Specifically the BVIV, which is Bitcoin's forward-looking volatility index.
Yeah, exactly. It just dropped to 36.11, which is the lowest we've seen since late 2025.
Wait, really? That low?
Yeah, it's significant because it means the big players aren't, paying premiums to hedge against massive price swings. The market is physically compressing. Implied volatility is tightening up because while the smart money is hoarding, they aren't trading.
I've been thinking about this dynamic like the ocean, honestly. Like the retail panic is all surface chop.
Yeah.
And retail gets so easily distracted by that surface noise.
Oh, totally. Whether it's Ethereum's market dominance sliding below 10%, or like that technical drama where the SUI network completely halted for 6 hours over a bug patch.
Yeah, or even routine mechanics, right? Like Ripple unlocking a billion XRP only to, immediately relock most of it. It causes all these panicky ripples for everyday traders.
Meanwhile, below all that turbulence, the whales are operating on an entirely different timeline. They are in a strictly Bitcoin-first regime right now.
Taking advantage of the panic.
Exactly. They're using the noise to quietly build out structural pipelines.
Right, and I mean, that structural pipeline is where the real story is for us today. The CFTC didn't just issue guidance, they formally approved 247 trading for Kalshi's Bitcoin spot perpetual futures.
Which is massive.
It really is. Because it means all this immense liquidity that usually flows to offshore, unregulated exchanges can now, sit legally on U.S. soil.
And that federal shift is mirroring exactly what's happening at the state level. I mean, Texas just formed a strategic Bitcoin reserve committee.
Right, and they brought in a top executive from the mining firm CleanSpark, didn't they?
Yeah, they did. So now Texas is joining Wyoming and Tennessee in treating digital assets as sovereign treasury reserves. It's a huge stamp of legitimacy.
But what really jumped out at me in these reports, like what blew my mind, is traditional Wall Street making moves into decentralized platforms.
Oh, the ICE news.
Yes. The Intercontinental Exchange, which is literally the massive company that owns the New York Stock Exchange, is in talks with Hyperliquid, a decentralized trading platform. And at the same time, Grayscale is setting up a $115 million seed investment for a dedicated HYPE trust.
It's incredible. And look at Stellar. Their native token surged 50% against the broader market downtrend.
Just totally defying the gravity of the retail panic.
Exactly, because they finalized a live tokenization deal with the DTCC.
And just to clarify for everyone listening, the DTCC is the central clearinghouse that processes almost all traditional stock trades in the U.S., right?
Correct. I mean, they clear trillions in legacy assets. So moving even a fraction of those real-world assets onto Stellar's public blockchain means they can achieve instantaneous 24/7 settlement.
Instead of waiting the standard 2 days for Wall Street's legacy plumbing to clear a trade.
Right. Legacy institutions are realizing they have to adapt to these always-on rails, or, they'll just be rendered obsolete.
Wait, so that doesn't make total sense to me, though.
How so?
Well, if legacy systems realize they need to adapt, why is Jamie Dimon, the CEO of JP Morgan, going on this huge public offensive against Coinbase? He's vowing to spend heavily to lobby against the New Clarity Act.
Yeah, that is a big clash.
Right, because if these banking giants think crypto is just a passing fad or something they can easily co-opt, you don't spend millions of dollars aggressively swatting at a fly.
Well, that reaction actually proves the point, I think. Diamond's lobbying efforts suggest JP Morgan views decentralized architecture as a direct existential threat to their traditional banking monopoly.
So they want to restrict integration to preserve their current dominance. It's totally a defensive move.
Exactly. And it's not just corporate warfare either, it's geopolitical. The reports show the U.S. government just seized nearly $1 billion in crypto tied to illicit Iran-linked funding networks.
Wow, $1 billion. The sheer scale of that proves crypto is now a fundamental tool and honestly a weapon in global statecraft.
Right, which brings us back to the core lesson of this late May data. The underlying tokenization infrastructure is being cemented right now, even while retail is panicking.
The weak hands are basically being shaken out by short-term volatility.
Yeah, precisely.
So the big takeaway for you listening is simple. Stop watching the daily scoreboard and start watching the players. I mean, sovereign states, Wall Street clearinghouses, the New York Stock Exchange, they are quietly integrating decentralized perpetuals and Bitcoin reserves today.
The foundation is literally being poured while everyone else is distracted by the noise.
Exactly. Which leaves us with a really critical question to consider before we wrap up. If the smart money is hoarding Bitcoin and building out these massive institutional pipelines in the background, what happens to everyday retail investors when this compressed market finally snaps open?
Yeah, that's the big one.
When the real liquidity flows, will you be priced out of the new financial rail? Just something to chew on.